Hello traders, welcome back to the channel and to a new video. Today I'm going to be talking about a concept that a lot of people had asked me about, and that is the fair value gap, a concept that has mostly been talked about or introduced by the inner circle trader, even though this pretty much uses basic concepts of market structure, price action, gaps, etc. Just a lot of different components that are already all related with other aspects of trading, but it is a concept nevertheless that he popularized the term. And even though it is something that I don't actively use in my trading, as I'm more focused again on volume profile and order flow, a lot of my followers have asked me about it, and so I wanted to just make a quick video going over how I personally understand it and how I identify it, and used to look to use it a lot more before, when I started more with ICT concepts back in the day. So first thing, let's just go over a chart. And if you notice, most of the time when you have candlesticks and you have candles one next to the other, price is going to come back and you're going to have wicks on either side of the candles coming back from both sides. However, and this is very prevalent everywhere, sometimes you're going to have, for example, like you have here, where you have a candle with one candle to the left, one to the right, but there's no wick overlap on either side of this candle. This is something that I've observed a lot. So basically, this is the concept of what a fair value gap is. The key is to know where to identify it when it is at levels that it's going to give you some kind of edge or some kind of good signal in order to look for you to do business at that level. So the main thing with fair value gaps then again is when you identify, you have three candles with a middle candle, and then there is no overlap between either the body or the wicks from the two candles on either side. But the key thing you want to look for, and this is what I think makes the most, the best setups using this method, is you want to look for a break in market structure to be caused by this impulsive move. And then this fair value gap that is left is an area that then you can look for entries on pullbacks. So for example, here you have a market that is in an uptrend. We come down, we break below a significant swing low, shifting structure lower. So now we're in short scalping, we're scouting shorts. And now what we're looking for is a retracement to then get short based off of this shift in market structure. Now, the concept of order blocks, which he talks about a lot, which is basically just like supply demand areas or consolidations and price, is very related into this. A lot of times you're going to have an order block that is pretty much lined up right above or below a fair value gap. So these two almost go hand in hand, but fair value gaps are usually going to give you an earlier entry than the order blocks. So for a bullish order, fair value gap is the same thing, but in reverse. In this case, we have a market, we're coming up, then we have a move down, then we have an impulsive move up, we break this previous swing high, and now we have a gap here with three candles, and there's no intersection on either side with the wicks into the middle candle. And so now we're scouting for a pullback, and an opportunity to get long within this range here. If you have very wide fair value gaps, you can also use your Fibonacci tool and mark up a 50% line, and then that'll let you, instead of going in right at the beginning of the fair value gap, you can get in at the 50% level. This might cause you to miss some entries because maybe it's going to bounce before, but overall it's just going to give you a tighter risk reward. If you go here and your stop is here, but if you go here and your stop is here, then obviously your risk reward ratio is going to be a lot better. So let's just go see a few examples on the charts. This is an SP 500 futures hourly chart. And again, this is seen everywhere on the charts. Like you can see, for example, there was a gap here, there's a gap here, there's a gap here, there's one here. But the important thing is to identify it in good areas where you're expecting or you want to see some kind of retracement to get an entry with the trend. So for example, right here, we have this swing low. Market comes down. I don't count this one yet. But then here, when we go down, we break below this low. So now we're looking for a pullback entry. And then we have here, this area right here, this brown area. It's an entire fair value gap. Since you can see that we have the wick low here and then the wick high over here. And you can see this, I would not consider this for an entry because we have not yet broken below the swing low. But once we broke down here, now then I'm looking for short entries on pullbacks. And then like I mentioned with the Fibonacci, you can take a Fibonacci from here down into here. And you can see right here, this would have been a 50% entry on this. You can see that actually this was sort of the low. Price started consolidating, making a triple bottom here. So we did not get a good follow through. But I mean, either way, if you're just intraday trading, this would have been a very nice reaction right here. This was a move of about 50 points to the downside from there. If we go into the next example here, you can see again, we had this big resistance level, this previous swing high, and then we come up and price has a very impulsive move up, breaking this and shifting market structure to the upside. So now we're looking for pullbacks to go long. So immediately, I will be looking at this broken swing area. Then below that, we also have this bullish order block right here. It's basically the last consolidation or the last move down that before price broke out. And as you can see, right above this, we have a fair value gap left right here on this impulsive candle. We also have a smaller one here actually, which I had not marked. And as you can see, we did get an initial reaction from this smaller fair value gap as well, right on this wick here with a nice bounce. But then we come back down into this larger one. And as you can see, the order block was not touched. So in this case, this is where fair value gaps are useful because you can get an earlier entry that you might have missed if you just waited for a perfect touch right here from the release point. And same thing that we talked about here. You can pull out a 50% Fibonacci level if you want to refine your entry right there. And you can see you would have gotten two opportunities of a nice entry here on the 0.50 Fibonacci in this larger fair value gap. Let's go into Euro US dollar and see some examples on a lower time frame. If we go into a 5-minute chart, this is a concept that can be applied to any charts. I see if you follow ICT on YouTube, you see that he applies this a lot, for example, on the 1-minute time frames. And you can see right here, this is a 5-minute time frame. We have market coming down. We have this brief move up here to the upside coming up, and then right here on this move down we start wicking this swing low, and then finally on this candle we break the structure further to the downside. So now right here we have the 5-minute supply order block resistance. We have this whole gap here in between this impulsive candle. So as you can see, we have a fair value gap in this whole area from the wick of the candle on the left to the pullback wick on the right. So this whole brown area is our fair value gap. And so again, we can also take, when you have a very wide impulsive move like this, then you can pull out your Fibonacci and then line it up. And then as you can see again here, you had a nice pullback here. Now, price could have perfectly come up and filled this all the way up here, and you could have looked for an entry here on the order block with a stop right here. But as you can see, fair value gaps give us earlier entries because sometimes we did not get a pullback all the way up here. Now, as far as stop placements on this, well, in this case, you know, the order block would have given us a tighter risk reward because our stop would go here and the entry would have gone here. With the fair value gap, you would put your entry here and your stop, you would just put it just beyond the gap. But again, you run the risk of possibly getting stopped out if we do get a deeper pullback into the order block. But you can see how order blocks and gap and fair value gaps a lot of times go hand in hand, one right behind the other. Okay, and that's pretty much it for the video. Hope this has been helpful to learn this concept. Again, this is something that you can back test, see if it brings value into your trading strategies. And that's pretty much it. If you have any other requests for topics or things you want me to cover in the videos here, let me know down below. Make sure to subscribe, and I'll see you all in the next video. Take care.